At this point, we are in Finance Friday, so we're going to have four gentlemen talking with Mark Gerstein of IHG about financing from a macro picture. We've got three lenders and a borrower. The borrower gets to leave early to, as he says, go sign his life away this afternoon on a deal. So at this point, please welcome to the stage Mark Gerstein.
Good morning, everyone. I'm delighted to be here.
So it should be on the side. Just sit here in the middle.
My name's Mark Gerstein. I'm Chief Capital Markets Officer at IHG for the Americas. I've been here, fortunate enough to moderate for a few years, and I've been with IHG for 4.5 years, and previously I was a banker at UBS and Morgan Stanley. We have a very compelling agenda here to cover today in terms of the financing markets. We'll cover 5 topics. First, we'll talk about how to finance stabilized hotels. Then we'll head and discuss how you're financing renovations. We'll discuss the construction loan market. And then the last 2 topics we'll cover will be more macro, especially with everything going on in the markets over the last couple of days with the tariffs and the volatility. We'll discuss buying and selling in the current market, as well as just the macro considerations to think about when you're financing. As Lee mentioned, we have 3 lenders and an owner on the panel. We have a very qualified panel here to discuss the financing markets. First, I will make my introductions. To my left is Scott Andrews. He's a managing director at Wells Fargo Franchise Finance. He is charged with building and growing a new platform for middle market hotel lending at Wells Fargo, and previously he ran originations at Western Alliance Bank as well as at GE Capital Franchise Finance. To his left is Mark Laporte, who's president and CEO of Concord Hospitality Enterprises. Mark founded Concord in 1985, and Concord is in both the hotel management business as well as a developer of hotels. It's one of the largest hotel companies out there, and they have worked with their owners and investors on over $2.5 billion of premium branded hotels since the company was founded. To his left is Jason Auerman. Jason is a managing director at Bank of America Merrill Lynch. He's responsible for originating both CMBS loans as well as balance sheets transitional loans, and we'll go more in detail about the products that he covers when the panel starts. And he was previously with Lehman Brothers, Rubenstein Partners, and JLL. And John Wright, to the far left, is chairman and CEO of Axis Point Financial. Axis Point is a direct lender to the hospitality business and an advisor. They've done quite a few deals. Him and his team, since they founded in 2011, have worked on over $3.5 billion of debt and equity investments. And its team prior to that, over their whole career, have worked on over $9 billion of debt and equity investments. So with that, let's start with the panel. So I'll first ask Jason to lead it off to give an overview of the CMBS market, given we're talking about first financing stabilized hotels. If you could give us a view of where pricing is and the current state of the market.
Great. Thank you, Mark. Well, good morning, everybody. It's nice to be here. The CMBS market, really it's on good footing right now. The market broadly, and then I'll get into what pricing looks like in leverage and structure. But the market broadly is very healthy. We had the wind at our back basically in 16 and 17 with close to $200 billion of CMBS loan maturities that we got to tackle. But this year, next year, they're going to be a little bit more challenging to find product as there's only about 30 to 40 billion of loans that are CMBS loans that are maturing this year and next year. That said, I think the overall market, 95-ish billion last year, probably comes down a little bit for CMBS year to 85, but that's not like a lack of appetite to lend. It's really just a fiercely competitive market with a lot of different capital sources to compete with. CMBS, though, right now, just what is our program? I think most people are pretty familiar. It's primarily a fixed rate product for hotel loans, 5, 7, 10-year fixed. Max leverage is 75, but really based on rating agency constraints, you were seeing most of our loans in the 65 to 70% LTV range. Amortization is largely 30-year AM. The interest-only period is going to be determined by the LTV that you're going in. So if you have a low leverage loan, 50, 55%, you could very well have a full-term interest-only loan. Pricing is benchmarked off the swap rate, and as we've seen, rates have been creeping up. So I would say, a full leverage loan, and full leverage to me is not necessarily just LTV, it's really cash flow constraint. When you're cash flow constrained on your last dollar proceeds, a 10-year is probably pricing in the high 4s, and a 5-year is in the low 5s coupon. Quality in our market matters, but cash flow is really the key to pushing leverage. In our space as well, there is a heightened sensitivity to the flag, the term of the flag, the manager. We're going to touch on some of these other points, I think, later on, but that's the general overview of the CMBS space.
All right, turning it to Scott here. You're in a new platform this year versus last year. Could you discuss what are your capabilities now at Wells Fargo, and how would you compete using your bank balance sheet versus a CMBS loan?
First of all, I'll comment that the slide probably behind me still says Western Alliance Bank, which is where I previously was, and GE Capital, which Mark said, but currently with Wells Fargo, been there about 8 months. So I'm excited. So about 8 months ago, the bank decided to launch a national hotel franchise finance division focusing on the middle market sector. In doing so, the bank broadly expanded its specialty hospitality lending focus to the industry. Wells Fargo has always had a very robust legacy hospitality finance group. It really caters to the institutional sponsors and bigger markets and larger deals, but really had a big void on covering the middle market sector, which in my mind is the majority of the space. So the launching of our new group fills that void for the bank. So we're obviously a real estate balance sheet lender. We continue to focus on premium branded, select service, extended stay assets across the United States.
And maybe if you could cover a little bit, where is your pricing today? How do you compete against CMBS in terms of how much term could you go out to?
We have I think we compete nicely with CMBS. We have a 7-year non-recourse financing option, not to the full 10 years, but it gets you close to that. It's a balance sheet loan priced in low to mid 2s over the 7-year swaps, or we can do it over LIBOR. So good cost of funds.
Where does that work out to all in then?
5%, 5.25% in that range. With the indexes going up, it's hard to say daily, but anyway, a nice all-in price, balance sheet loan, and the benefits of a balance sheet lender obviously is flexibility. So we offer flexibility around prepayment relative to traditional CMBS financing, as well as how we handle escrows, whether it be for taxes, insurance, or FF&E reserves. So the nice part about Wells Fargo, if we have a customer that is adamant about 10-year non-recourse financing, we have our own CMBS execution as well. So it's nice to be able to offer the customer both products.
Okay, so Mark, it's nice to have an owner on the panel here to talk about how you think through all these different lending products. So when you develop hotels and they stabilize, how do you think through how should I finance the hotel once you kind of have the cash flow up to the stabilized level?
Concord's a very active developer, and since we are developing, building, hopefully creating a lot of value along the way, and then look for an opportunity to, as I like to say, harvest and then do it again. Flexibility, therefore, is very important to us. We want the ability to get out of a loan, exit at any time, as easily as possible. Hence, we shun CMBS. Just doesn't work for what we do, our model, although in the past we certainly have done some CMBS loans. What we do is not that exotic. We look for typically 65% loan to value deals. Since we've been doing it a long time, we have and been successful at it. I think we are among the leaders in finding good pricing. That being said, it's really good to see Scott and Wells Fargo, because years ago I used to do tons with your bank and they totally went away. And hence the mid-sized banks and even community banks are our go-to banks in recent years.
So when your construction loan comes due, then you'll refinance with some examples of the type of banks?
Yes, just commercial banks, non-recourse, usually 5-year deals with the ability to get out with either a small prepayment, and with all but a couple exceptions, we choose to float our rates.
Okay. John, so you have a new owner right now of Access Point Financial. Could you give an overview here of what new capabilities you have given your new owner, and then we'll talk about stabilized hotels afterwards?
Sure, Mark, thank you. And to Bob Hunter again, as usual, happy 30th anniversary, and to the Hunter boys, and thanks for having us once again. I'll have to, of course, compress my answers today, Mark, since you cut me off last year.
Everyone will appreciate that.
A little early. I thought we were going to have an orchestra pit here to start the Oscar music, but the primary challenge is the stopwatch is upside down, so it's confusing a bit, but it does look like our rates. It does resemble our rates. It's constantly dropping. We are recapitalized since the last time we had the opportunity to have this discussion. Our company in 2011 was recapitalized by Stone Point Capital, a group of Goldman Sachs retirees out of Greenwich who were kind enough to commit to $400 million of equity into our company alongside management's investment. And we leveraged from 11 up until until August of this past year, we were 3-to-1 leverage with Wall Street partners. It's a great example of Main Street to Wall Street, where our equity as partners are in the transaction in a first loss position, and we principal every loan. We're direct. But alongside of us for our leverage capabilities, we have the likes of JP Morgan, Credit Suisse, KeyBank, a number of others, and it's been a very good transition. We are now majority owned by Wafra Capital Partners, say that, Wafra, W-A-F-R-A Capital Partners, a Kuwaiti-based concern. So, as many of you know, the equity that was originally committed to us, you eventually run out of your allocation, as those companies, Stone Point specifically, are geared to seed reorganized entities, as such was our case coming out of the financial crisis. And then we had a very nice offer to sell the company to Wafra, which takes those maturing companies that have been reorganized to the next level. It's primarily funded by Kuwait and the Kuwaiti government's pension fund. So we really don't have a limit, a cap, if you will. It's a very good ally of the United States, and we're very pleased to be now managing and operating the business with Wafra Capital Partners, and our management team owns a good portion of the company as well, so you are able to enjoy very quick turnaround and direct access from our headquarters here in Atlanta for any response that you may need.
Okay, we'll get back to your products in a few minutes here. So Scott, could you talk about now the underwriting you see for stabilized assets? What are the debt yields that currently you see in the marketplace to make a loan work, and how will that compare to last year? Are things getting tighter, easier?
Sure. Yeah, I don't see a lot of change this year from last year. It's still a combination of LTV and debt yield. Our debt yields will range in 11 to 12% range. If it's in a smaller secondary market, we're probably going to want a little bit stronger debt yield, maybe even slightly less leverage. If it's in a CBD, top 25 market, top 50 market, with an asset we really like, we're comfortable in that 11 to 12% range if it's considered stabilized. We'll also, as all lenders do, this isn't exclusive to Wells Fargo, obviously, but we will look back 2 or 3 years to see how that property could have handle this debt load that we're putting on it today to make sure that we're not, lending at the peak of this property. But equally as important, looking forward into new supply to see how the TTM NOI could be impacted by new supply, and therefore reducing our debt yield on a go-forward basis. So it's just kind of an all-encompassing underwrite, looking out the rearview mirror and looking out the front windshield to make sure you're putting the proper amount of debt on a property.
Okay. And last question on the stabilized asset debt. Jason, the floating rate market has come back this year here. Maybe if you could update the audience in terms of where's the market and what's the minimum level of borrowing you need in order to actually access it.
Right. The part of the CMBS market that was really a pleasant surprise in 2017 was the strength of the floating rate market. We've always been able to do floaters. Sometimes we aggregate floaters, sometimes it's as a standalone deal. 2017 really saw a wave of refinancings of floaters with single asset, single borrower transactions at spreads that frankly were 200 to 300 basis points tighter than 2016 levels. Just examples of what I mean. 75, 80% LTV portfolio financings, and these are large loans, anywhere from 250 million or greater. You're inside of 300 over. At 70, 75% leverage, full term interest only floaters with 7-year term, we've executed inside of LIBOR plus 250. So the nice thing about the floating rate CMBS product is all of the things that people don't like about the CMBS product, which is largely that look, it's a fixed income product, so we have prepayment penalties, and we do have some restrictions on material alterations to assets and things that could change the collateral. But the floating rate product competes well with banks. It's a nice complement to what our commercial bank can do. Call protection is typically 12 to 18 months on a 7-year. On a 5-year floater, it's 12 months. So it's a nice weapon to have in our arsenal right now. The depth of investor demand on the bond side for floating rate bonds was very strong. It remained strong. And the reason it's surprising is because the natural buyers of floating rate bonds was historically structured investment vehicles that really don't exist today. So it's really the same types of investors that are buying fixed rate in this cycle, which is different than the last cycle, but no lack of appetite, so it's been really good. But I would say to access that market, the smallest deal size is probably 150 million in the mortgage, excluding any mezz that may be behind it. But it's most efficient when you get to about 250 million in size.
And it's also important for the audience to realize here that if you have a Holiday Inn Express or a hotel, you still may benefit from this because there are a bunch of big aggregators of private equity funds out there who are aggregating to take advantage of this, and that impacts pricing as well here. Right. So there are other advantages even if you can't access it with your one hotel. So now turning to renovation of properties, Mark, if you could, you just did a nice renovation of a historic building in New Jersey. If you could give an overview of your Hyatt House renovation, and how did you finance that?
In a word, it was painful.
Yeah.
Today, as we all know, those folks here that are constructing anything, that contractors kind of have their way with us versus a few years ago when we really felt that we had our way with them because of demand. Very difficult deal because a historic building that we actually added a 48-foot hat upon this building that overlooks New York, right on the path of the shore of the Hudson River. But and it really illustrates what has happened in the history of select service hotels in our company, for sure. This was a hotel, 258-room Hyatt House with some really cool retail space at the ground level that all in was nicely over 100 million. I could not even imagine talking about a select service anything at 100 million 10 years ago. The way we financed it was with a lender that we had a strong relationship. Many of our deals, most of our deals, that's how we do them because we do them repeatedly. In this case, a mid-sized bank liked our story. It was really a total turnaround from a building that had been first a bank, then an office building, and now a beautiful Hyatt House. Our intent was to put 65% debt. You heard my word paying. That now probably is only 50% loan to cost because we had to come to the table with more equity because of those overruns. And that is like beautiful, beautiful hotel. Probably that type of building is, I see it, more difficult to finance in 17 and 18 than it was in 16 because spreads, of course, are greater. Lenders are more concerned with new supply, hence there is some pushback. All in, though, we're already seeking to refinance the hotel and have gotten a quote to get some of our money back out only 4 months after opening.
In the bank, did you try going back to the bank to get a little bit more leverage given the cost escalation? Did they just cap you out at that point?
Yes.
Okay, so sometimes it's not easy, but it's worth a try.
Sure
So, John, if you could give an overview for heavy renovation products of hotels, what products do you have to offer that could be helpful for the audience?
Well, it's interesting because Jason's example of his sweet spot on loan size, 150 million and north thereof, really starts to move their needle, maybe. But our average transaction is $5 million. We are working on an $80 million project right now, Grant Park in Chicago, but without the institutional breadth that the B of A's and key banks, our partners, the 150 to 500 million, as an example today, is the range that those banks approve us for operating lines to leverage our loans, and so they're able to keep the regulators happy with their exposure to hospitality because we will bring down their average loan size dramatically if we're closing 10 transactions a month and averaging 5 per. Every dollar out the door, a third of it is ours, and it's our equity, the ownership equity. The other 2/3 obviously is leveraged with institutional funding, and that's worked out very well for us. They are able to commit large lines to us, recourse lines, and with us taking the first loss and having the historical metrics that we have, less than 1% of bad debt, we're still able to lend now in the single-digit range for our senior and even some sub-debt products we have, and we are participating throughout the capital stack in every component, but certainly we lean on our Wall Street partners, those large institutional lenders that we partner with and have for quite a few years now. The performance, as everyone knows here, is that you're scrutinized heavily by the regulators, and although we are not a bank, we are certainly supported by regulated entities, and so we govern ourselves, and we have audits, quite a few audits from all the banks that leverage us. So it's really a good balance. We're able to close on transactions. Senior debt, we're somewhere in the 7 to 8% range, more expensive than the banks, what was quoted here earlier, but certainly we're not borrowing from the Fed. We have a point in, a point out of exit, no defeasance to speak of, and the vast majority of our loans every month close within the last 3 or 4 days of the month. Our prior owner took interest in us and funded our equity because they were founders, the seed capital for auction.com, which is now 10X, Citus, the servicing organization. And so we are able to achieve 200 to 300 basis points additional yield based on our ability to close in roughly a week. Not a depository institution either, so we're not requiring some of the belts and suspenders that you'll have, of course, with the banks, and we're interest only. So what that does, especially in the renovation sector that we serve, changing hands, acquisition, bridge lending, when we're turning those loans around in a week, that certainly takes a lot of the argument off of the table about your cost, which we hear often, you're 2 to 3 points higher than our bank, and we say, well, good luck closing in a week because you're competing with REIT and other cash buyers, and so yeah, it's the opportunity capital. We're still achieving, I almost said steal, we're still achieving the similar returns as a bank, but our cost of capital obviously is a bit higher with the private equity. And then our bank lines come in at L plus 225. So all in blended cost of funds, we're coming in at 150 to 200 basis points over the bank cost. But with your interest-only component, it has proven out for now 25 years. The average life of our loan, putting aside the term, the original term, the average life of our loans is 18 months. So that's how we get to a low double-digit ROE when we're talking about debt yields. We are looking for that takeout, which comes with life companies, with larger institutions. Might be Scott that comes in behind us, and as I've said in the past, a lot of BB&T type takeouts and large insurance companies.
Hey, Jason, if you could comment on CMBS as well as your balance sheet loan program for bigger renovations at hotels, what works, what doesn't work for your program?
Right. This is where our box starts to get a little smaller. Just to note, so I talked floating rate before, the size, 150 and greater. Actually, most of those are about 500 million-ish or greater. But on the fixed rate side, our conduit average loan size is only 14 million. So we do any size loan on the fixed rate side. For renovations, on a fixed rate loan, look, the basic playbook is if there's any unfunded PIP costs that you know of or related acquisition renovations that you have to do, we're going to reserve for it up front. It's just that simple. A fixed rate product really wants to manage renovations that are soft goods, hard goods, but not like major rehabs to a property, which would actually cause a significant dislocation of income. I mean, once again, this is a fixed income product, so we want to make sure that anything that is being handled in a CMBS loan, the scope of work can be managed. Maybe there'll be some impact, but it can be managed by taking one floor off at a time, maybe 2 floors during the down season. For PIPs that may be coming, in the future, so your flag rolls in year 6, 7, 8. The structure that we're always going to have is we're trying to figure out what does it cost for the particular flag. Is that 10,000 a key? Is it 15? Is it more? And then we're going to want to reserve. So it could be a combination of upfront, ongoing. We'll give some credit to money in the standard FF&E reserve account. We could do springing guarantees, springing letters of credit. However we get there, we just need to make sure we have the appropriate dollars. We do have belts and suspenders in our loan docs where the loan is recourse for losses if you lose the flag. And for us, there's nothing more important when you're lending on a hotel that flag stays in place for the term of our loan, because obviously a lot of the value is tied to the flag. If I switch gears to our balance sheet program, so within structured finance, which I oversee, the structured finance bucket is not doing construction lending. That would be in the commercial bank. It's very light touch there as well. But what we are doing, and a lot of the hotel loans that we do on balance sheet in my group, would be coming out of a renovation. And you don't have the historicals to put a CMBS loan on because you need at least a trailing 12. Really, 18 months is better, so you could see some year-over-year trending. But we could take those down right away. 1-2 months of operating history, post a renovation, put it on the balance sheet, and hopefully refinance it later. But if it refinances away from us, that's fine as well.
And what's the cost of that money?
That's typically LIBOR plus 400, anywhere from 350 to 400 over for most of the hotel loans we're doing on balance sheet. We've gone inside of 300 once, but it was, frankly, it was just a very attractive loan, low risk.
And is there recourse associated with that?
Non-recourse. Everything is non-recourse in my world.
All right, so Scott, could you give the audience an overview of Wells Fargo's franchise finance program for hotels with major renovations right now? Could you do those?
Yeah, so I'll touch on 2 things. So all acquisitions are going to have a brand mandated PIP, and if that PIP is not a large one, in most cases, if it's sponsors that we're comfortable with, we'll fully fund that PIP day one and get out of the Mark's way and let him do the PIP versus us administering that and doing draws. So that's the easy way to do it. If it's a more comprehensive PIP, a value add PIP, if you will, we'll likely have the sponsor fund his pro rata share of the PIP up front, and then we'll come in behind him and fund our pro rata share of that PIP to make sure that we're not overfunded on our 65% LTC. We're always going to get a completion guarantee, and if it happens to be kind of a deep repositioning turnaround, there may be some limited recourse until the PIP's done and stabilized.
And what's the spread difference for major renovation versus a stabilized hotel?
Yeah, we don't differentiate hugely because we're so sponsor focused. So for example, if Mark's got a stabilized asset that we like or one he's doing and we like that conversion, there won't be a huge difference in our pricing there. Although there is a little bit more risk. We'll price a little bit to balance out that risk. But in our program, there's not a huge variance.
Okay. Now, turning to the construction loan market, Mark, could you give an overview of another deal you did to give where you accessed capital for your Hilton Garden Inn in Roslyn, New York, which was ground up? How did you finance that deal? And maybe give a quick overview of the actual project.
Sure. Again, the debt that we chose, not very exotic because we were planning to put about 35% real cash to cost into that deal. So we went out and looked for competitive pricing from about a half dozen lenders. I will say that it's harder to get half dozen today than it was maybe 24 months ago. But the pricing was, by memory, about 305 over 30-day LIBOR, recourse through construction, and then with a burn-off provision. But as it happens in our company, because we like aggressive pricing, the word recourse becomes more important to the lenders if I'm going to buy debt as low as I can get it. We had a choice of doing it as a non-recourse transaction at completion where we would blend a lower levered first mortgage loan of say 50 or 55% to cost, and with a mezz strip on top of that, but the all-in lending cost would have been at that time probably in the 6 to 7% rate.
Would there be more leverage in that case?
Yes,
okay.
there would have been 70, even up to 75.
Yeah, so it would have been a trade-off of a little more expensive debt with a little more leverage.
And yes, and in our world, I'm not adverse to recourse, although I don't like that word. We've been fortunate, and lenders know we don't throw the keys back if there is a need in a down cycle. So we choose to generate more return for our partners by buying debt as low as we can get it and taking some, again, larger recourse responsibility.
Okay, John, could you talk about Access Point's financial products for new construction loans? And when are you involved with that? Maybe talk about your FF&E loan product that partners with some local bank lending.
Yeah, we continue to shy away somewhat from ground-up construction. Probably a dozen transactions a year, like I mentioned previously. High optics, something like this Grant Park. We did the Staybridge Suites in Times Square a while back. But we have the opportunity and the mechanical wherewithal and more importantly, a rated servicer. We securitize our debt on a regular basis, and we've achieved on a hotel vertical product offering investment grade ratings, which is unique. We've been able to work with the brands when they come to us, and they are going to garner the management agreement. They will oftentimes pitch leverage to 50% loan to cost. So we look at loan to value when we have a trailing 12 months, typically trailing 24 months. Then we'll give a loan to value credit. But we're able to fund 25% of our overall annual target, which this year will be roughly $600 million on ground-up construction. Knock on wood, we've had no real issues from the time, and private equity were charged on the capital cost the day that we commit to the loan. And so it's really difficult to find a borrower credit profile that matches the willingness to take on our costs. Again, it's going to be high single digit in that case because we're going to have to stress future unknowns, if you will. And so we are currently active in that market space. We're very nimble to deal with, and that's why the brands will come in and sponsor a transaction again if they have a 20, 30-year management agreement. It's not our core business, obviously, by the references of 25%, but we do come in on a great many transactions where the banks, typically community banks, and even some life companies, on occasion will allow us to plug the CapEx component. So that's 20 to 30% of the cap stack. So the banks are quoting 50% loan to cost. They allow us to come in last in for the CapEx funding. And because the very quick amortization of that CapEx and going back to our interest-only component for 18 to 24 months, typically we're out. Today, that average life, it varies month to month in our reporting, but it's 22 months average life. So our money really is to be looked at in those instances as something much cheaper than equity cost, rather than someone arguing with us that you're more expensive than my bank.
Yeah, it's also cheaper than mezzanine debt as well here. Where it's
by far, and so that's where, we, not only for a ground-up construction that is very key in a gateway city to the brands, all the way to rolling out programs, especially after acquisitions and rollouts of emerging brands, to where the brands will actually put us on their website, whether it may something less sexy like having to renovate all the beds, have to change out TV programs across the board. And we don't necessarily like to transact $50,000 transactions. It's as easy as a $5 or $50 million in some cases. However, it brings incremental and residual business behind it. So quite a range on the low side of 50,000 up to 80 million as we start out the year. But the construction costs, the construction variables, more oftentimes than not, we are just not scientific enough to get comfortable with all of the political or economic swings that can occur from day one to CO. So that's how we hedge our bets on the construction, is just to simply partner when the brands come to us and take it down to 50% loan to cost.
So Scott, can you give an overview for the audience of Wells Fargo's capabilities in construction, just not your group, but also the hospitality group?
Yeah, absolutely. So it was important to me when I started the group to, on the front end, get construction financing approved internally. So we have credit approval to do construction tomorrow if we want to, but frankly, as our group started up, we've been more than busy doing acquisition and refinancing at this point, so we're not choosing to enter the construction financing component of it. Although we do have what I consider a very aggressive construction takeout product to alleviate that construction lender to free up financing elsewhere. We're doing, I'll give you two examples. We're doing a dual branded Marriott property in a top 10 CBD downtown, and that's got 3 months of history. And we're doing a 7-year fixed rate deal on that. It's got, I think, 20% recourse on it and a very quick burn off provision to where that recourse goes away. The other property is at 12 months of history, and we're doing that non-recourse and actually giving some cash out on that because construction costs have gone through the roof, since that property started, and it appraised, considerably higher than what it cost them to build it. So that's kind of two examples where we're filling a nice void for Potential borrowers like Mark who are building 10, 12 properties a year, or maybe their construction lenders are filling up, and it allows them to free up that capacity. And it also doesn't bog us down with doing construction financing. And then our larger legacy hospitality finance group is doing some construction. It's very, very limited. It's with sponsors who have a deep history of building, high quality assets, on budget, and in most cases, existing customers that they have a history with. But neither groups are, heavily pursuing ground-up construction.
And where do you see pricing now for ground-up construction today when you're talking?
I don't know, high 2s, low 3s spreads.
Okay.
Yeah.
So Jason, we know you're in the CMBS business, but Bank of America is a big bank. They have the other side of the business in terms of the retail bank here. Could you just give an overview of what B of A's view right now is for construction lending?
Yeah, I'll be somewhat brief just because, as you mentioned, it's not my book, but B of A is still making construction loans. They're just very particular about the client. And I would say if you're not an existing borrower of the bank, it's going to be extremely difficult to get a loan to put a shovel in the ground. The bank, like most banks, right, they focus on the relationship first, and a loan is just one opportunity to make money, but that credit is not what drives the bank. It's really the relationship. So if you are a client of the bank and you've been a client of the bank for a period of time, then there is an appetite still in the bank to put money out on the construction side. I apologize. I don't want to speak to the terms because they're so wide from a pricing perspective that it could be on both sides of the spectrum of what we're talking up here. But
okay.
I would imagine it's going to be in line with what Scott's pricing was.
So last question for John on construction financing here. You're in the market all the time. Who do you see are the active lenders right now for construction financing?
Yeah, it still goes back in the middle market where we play. There's still such good availability of capital. We're not losing transactions in reverse auction type conversations with our clients. Of course, you could just be losing business and not know it, but we do drill down extensively on if a deal moves away from us, why is that? And so as B of A would, community banks are still there. You've had to have been a well-entrenched client of that community or regional bank for some time, and also have the goodies to offer up for reciprocation. Your operating account, of course, would be run through the bank, your other accounts and assets locked up by the bank. And being, like I said, non-depository institution, we don't have that card in our deck. And so you drive by any construction sites, we all do, and take a look, and it's typically regional or communities that strong partnerships and 30 to 50% cash in the transaction with a well-regarded either third party or in-house management company.
Okay. Now turning to the more macro environment, and I thought we'd start off with Mark here to talk about, given where we are right now in the cycle here, how do you think through selling into the current marketplace versus refinancing your assets?
We do both. I've been surprised, even at this meeting, to find that there's still some very aggressive buyers out there looking for product, which has the end result, cap rates are remaining low, maybe lower than I would have thought, especially given what's happening in the lending market with higher rates and higher spreads. So great time to be a seller if you have good product, young product. Also a good time to be a builder if you can find the right corner to put your branded hotel on that corner. But we are selling, we have 3 hotels under contract to sell right now, going to the market with another dozen or so this year, with our feeling that it is a good time to be in the market as a seller.
I think you'll see some sellers, if they're not getting to their price that they want, interest rates are still low, and they're just choosing to, either cash out some equity and just put it on a long-term fixed rate deal if they're not kind of getting the proceeds that they want. So it seems to be falling in one of those two buckets. If they're aggressively want to grow their portfolio, they're buying and they're inching up their purchase price to acquire assets, and there's a lot of groups that have funds that they have to deploy.
Agreed.
So.
Yeah, have to be deployed is the key, because we'll all see, we had a very robust January, February, which most of us pulled back a little bit on our budget projections. Historically, we have had the first quarter as being slower than 2 and 3, and then the very end of 4. But the bank concentration limits and the regulatory oversight causes, I think, just the natural dynamics of lenders within those banks wanting, they all have their budgets, their quotas, if you will, not so much announced as they used to be because of the regulatory oversight. But we're seeing a lot of money coming in. First quarter will close out strong for requests. Then we refer out those transactions that we cannot close in-house, and we've seen very good hit rates on term sheets to closing, but you had better get it earlier in the year than later, because the simple fact of hotel exposure weighs heavily, any asset class, but specifically hotel exposure, as most of you have heard directly from your banker in the past, that they are full on hotel exposure going into the third and fourth quarters. So that's where, when we structure many of our mortgages, we bifurcate the documents. So the land and building, which are supposed to be appreciating components of an asset, are on one document, and then we have on the separate the equipment. So a mortgage to us is not land, building, equipment. It's land and building, and then we have a separate document for the mortgage. And again, because that can be classified as C&I, commercial, industrial, the regulators have no problem with that, and it's not occupying your buckets for exposure in hospitality specifically.
So Jason, when you're looking at loans and you're going through credit committee, what's the talk at B of A in terms of where we are in the cycle? How long is this going to head? How, as a debt guy, do you get comfortable with how many more years do we have left here?
Yeah, it's a question where every single quarter, right, you have a different view. If you go back to late 15, early 16, we probably thought the cycle was nearing an end. You looked at public companies which are getting battered, and obviously it was all related to energy, but the markets are really trading off and then rebounded quickly. And with tax cuts, you're right, it felt like things were great. And a week ago, I probably would say there's probably 2 years of growth, and then we'll see. Not that it'll fall off a cliff, but there's really nothing, on the horizon that worries us. Although we're seeing growth slow and market by market. I mean, there are clearly weak markets in the country due to supply, but not on the demand side. Demand, for the most part across the country, we see is pretty strong. But the big but is every day something could come up in the news headlines. The talk of trade wars and tariffs. Obviously, the markets were rattled yesterday. I haven't looked at anything today. I'd imagine a minor bounce back. But anything that can impact the economy impacts hotels. Everybody in this room knows that, right? Your leases are overnight, so we feel fine. I mean, once again, it's with an unemployment rate as low as it is, it's hard to find examples of any recession with unemployment as low as it is, and with continued job growth. There's really nothing that you should be worrying about other than supply. So, where we are in the cycle, a large part of it is on the hotel side is because of the discipline from construction lending and the fact that it wasn't free for all. And in those markets where you were able to put, a lot of holes in the ground, they're feeling the pain right now because although demand still is strong, there's just a lot more mouths to feed in those markets. And so we've seen, a select group of where I'd say the cycle is probably on the downside. But I don't see anything there's nothing to worry about on the horizon from our perspective.
Scott, so if you could comment on a similar question, the Trump tax cuts, all the volatility going on right now in Washington, how's that impacting lending and Wells Fargo's view on that?
All the financial institutions clearly benefited from the lower tax rates. From a profitability standpoint, that's a plus. I will say it's probably going to have zero impact in terms of loosening up credit criteria to finance loans. That's certainly not going to change at Wells Fargo, and I doubt it will at any of the other institutions. So I don't see huge changes in the lending environment as it relates to the tax cut.
And Mark, where do you see us in the cycle right now?
I would agree that from an operation standpoint, we are on the downside. It's not for any reasons other than those that have been cited. As we all know, it's harder and more expensive to hire good employees. Margins are stressed because RevPAR growth is constrained. We budget in our hotels this year in aggregate to see about a 1.5% to 2% growth. That's not nearly what it was 3 years ago. And with that nominal growth in RevPAR against a growing cost across the board, whether it's human resources, insurance, and the like, that it's just harder to make the money we had made.
So, Mark, is that equating to more or less a flat NOI margin, or slowly growing revenues, but expenses are also growing?
Slowly growing.
Yeah.
Okay. So in terms of interest rates, obviously a big impact is what's the Fed do and where do we think interest rates are heading for overall borrowing costs for hotel owners. So Jason, could you comment on Bank of America's economist's view of where they think the interest rates are heading right now?
They seem to change their view when the market changes drastically. Right now, we're forecasting the 10-year Treasury to be 3.25 by year end. What's more interesting is that the 5-year is forecast to be at 3.15. So, one of the dynamics in the market now is, we're obviously seeing rates creep up. The Fed is going to keep increasing. They've forecast there'll be 2 more rate hikes this year. So, the short end of the curve has to move. It's amazing how flat the yield curve is right now. And for there to be a 10, 15 basis point difference between the 5 and the 10 is astonishing. And that's why, when I started off talking about the product, and I'm talking about 5-year fixed rate loans being more expensive on a coupon basis than 10-year, that's been the dynamic now for probably 18 months in the CMBS market, and it's due to the flat yield curve, because when you have a normal steepness in the curve, obviously shorter term lending should be cheaper on a 5 versus a 10. So LIBOR, I don't think there's any forecast other than what the Fed shadows as what it's going to do. So if they're saying they're going to, increase rates 2 more times, you have to forecast LIBOR are going to go up 50 basis points as well. So that's just the rate environment we're in. The good thing, with this is that, and we've been saying this for this whole cycle, even if it's 3.25, that's still historically low, and that in itself shouldn't derail any projects.
And where's Wells in terms of interest rates?
I would say spot on. I mean, it's saying a couple more this year, a couple more next year.
Okay. So John, you need to underwrite takeout loans, looking where cap rates are going to be in value, and how do you think through interest rates, how it impacts cap rates when you're kind of trying to view the risk of these loans that you're underwriting?
Well, we really aren't the go-to source for a takeout necessarily. We are the urgency capital, so not a longer-term view, which makes life a little better for us. If I could project, things a little bit more precise, we'd be in Vegas right now. But we are the go-to lender for a quick turnaround. Again, going back to the mid-market borrowers, which are the vast majority of the attendees of this conference, and in our view, that's up to $25 million, and being able to advance funds within a term sheet within 24 hours and close within 5 business days. We are the ones who are being taken out by the longer term view, and we have our research groups that we're able to lean on through WAFRA, and of course it's very advantageous for us to have 5 leverage partners of the scale that we have. If it's JP Morgan, Credit Suisse, KeyBank, then we are afforded the opportunity of their analysis of a longer term view. But with the average life of our loans only 18 to 22 months, we feel like that we insulate ourselves. It's not by design, but we're not having to look out as far in the crystal ball, if that was the question.
Okay. All right, interesting perspective here. So high volatility commercial real estate, regulations, obviously an impact on the lending market here. Scott, if you could comment, what do you see as the change in the regulatory market right now? Is it going to benefit owners out here when they look to finance? Will it loosen up capital at all for you?
I think there's some recommended changes that will slightly loosen up HVCRE. We don't do construction financing, so it really doesn't impact our business as much as it does some of the smaller community banks who are fighting the same regulation, but maybe to a little bit more scrutiny if they're heavy on commercial real estate. But it's at the forefront of a lot of lenders.
Yeah, definitely an issue we all
Mark,
stay tuned on. Yeah.
let me say this, though, back to your question, was every loan that we make, virtually every loan involves a new license agreement. That's where we partner pretty well with the brands because, of course, there are incentives for those field brand reps to be creating new license agreements or renewals of those agreements. And so we do take a look, I'll correct myself, which occurs regularly, that we are a lender and are able to achieve our return on equity and our target rates because we give a full 24-month look forward. So you have a direct lender that can turn it around quickly, and we believe and we negotiate that belief with the potential borrower. What is this asset going to produce 24 months forward post renovation? Because every sale that occurs, the changing of the hands, so does a PIP come forward in every case. And so we do have a 24-month look forward. And with that interest-only component, and we stress just the most simplistic of all of the stress analysis we run, 200 basis points of rate movement against our transaction. But again, even though it's a 24-month look forward, and we do advance those funds if it's a break-even cash flow at the time of closing or south thereof, then we are, as long as there is skin in the game from that buyer, we're quite comfortable in giving a 24-month look forward on the advance. So that's where we carve out our niche.
Okay, so last question here, given we're almost out of time. Jason, our owners are always interested how they can maximize proceeds here. Could you comment on the mezzanine market right now, availability of capital, where are the rates for, if you're adding mezz for an acquisition loan versus the renovation loan?
Yeah, as a senior lender, we think there's a lot of competition. As a mezzanine lender, there's more. There's a lot of players that are in the market. What I would say is, let's break it into fixed floating rate. For 10-year fixed, that's where there's the fewest mezzanine lenders that'll write 10-year fixed rate mezz loans behind a CMBS loan. Probably a dozen, but not 100 like there would be for floaters. And pricing is typically, I would say, 10 to 10.5% on most loans. If the mezz loan is smaller than $5 million, it's more like 13 to 14%. There's a premium there for the cost of doing docs and transacting. If it's your second or third deal with that lender, then maybe it could come down a little bit. On the floating rate side, what we've seen is in a lot of our large hotel floaters, we typically break up the mezz to a senior junior. The senior mezz space, call it 62.5 to 70%. That's typically pricing in the 550 over LIBOR context. When you're taking it from 70 to 80, that's more in the 750, 800 over context. So, which is really attractive when you think of most of these stacks on the floating rate are full-term interest only. And these are not loan-to-own. I mean, we obviously feel more comfortable when we put mezz lenders in that have a hotel expertise. That's just always a comfort as a backstop. But nobody's writing these loans at these yields to ultimately take the keys back from the owner.
All right, well, we've reached the end of the hour here, so I'd like to thank our panelists for their insightful comments and thank all of you and thank the hunters for a terrific conference.